Hello and welcome. You're watching a special show before monetary policy, and the house is divided, and so are the markets. Will RBI bite the bullet or for a rate cut or keep its powder dry? Inflation is at a 77-month low. Growth has slipped to 4-year low, and tariff risks from US are adding fuel to the debate. The policy meet is no longer a one-way bet. The rate cut camp is getting louder even as the pause camp stands its ground. First, let's decode what exactly is being priced in and what is the mood in policy corridors. My colleague Ashesha is joining with all the latest on MPC expectations. Ashesha, over to you.
Well, yes, first up, let's put the spotlight on what the broad expectation is from the Monetary Policy Committee outcome. Now, 77% of polled economists do not expect a rate cut from the MPC meeting this week. Now, remember, after the 25% tariff that was levied by US last week, odds of rate cut have now risen by nearly 25%. But of course, 77% estimates suggest that perhaps we will not see a rate cut this time around. Let's take a look at some other figures. Then 97% economists polled earlier expected status quo, but that now has fallen from 97% earlier to 77% now. And as I mentioned, this is because of the 25% tariff that was announced by United States last week. Let's take a look at where the current rates stand. We have CRR at 4%, SLR at 18%, bank rate at 5.75%, repo rate at 5.5%, and SDF rate at 5.25%. So these are some of the important rates that you need to keep an eye out on ahead of the monetary policy meeting outcome. To put things into perspective, WPI inflation currently stands at 20-month low. CPI inflation at 2.5%, which is at 77-month low, and we have demand concerns which continue to impact the kind of outcome Reserve Bank of India and the monetary policy could come out with in this particular meeting. Now let's take a look at GDP figures then. Fourth quarter FY25 GDP stood at 7.4%, and for the last full year, which was at 4-year low, we saw GDP which came in at 6.5%. We also have what brokerage houses are estimating for FY26 GDP. We have RBI, which is predicting 6.5% GDP for FY26. IMF a little conservative at 6.2%, World Bank at 6.3%, S&P Global at 6.5%, and CRISIL, which is also expecting 6.5% GDP for FY26. So anywhere between 6.2 to 6.5% is the broad estimate. As far as CPI estimates are concerned, RBI is predicting 3.7% for the month of June, and nearly 4% for the month of April for the full year FY26. So the estimate has changed from June to April. Now, apart from that, we also have GDP estimates where RBI as of June is predicting 6.3% growth for the fourth quarter and 6.5% for FY26. But yes, largely the expectation is that we are not expecting rate cut, but there's a consensus, there's a divided view that perhaps we could probably see 25 basis points rate cut in the meeting this week.
Thank you so much for taking the time out and giving us a lowdown of what can we expect from the MPC meet outcome. Ankur, there's clearly a divided house, right? Yes. While we were expecting that the RBI will maintain its status quo, now there is a slight clamor of the fact that there might be a surprise 25 bips rate cut.
And completely divided house, and so are our guests today. And we have Sameer Narang, who's head economist research at ICICI Bank. We also have Aditi Nair. We also welcome Kanika Pasricha as well as Madan Sabnavis. So we have divided house in terms of guests also. So first I want to come to you, Mr. Madan Sabnavis. You are expecting a pause, right?
Our conditions today very much different from what they were in June when the RBI took its decision. It's actually been almost the same. I'll tell you why, because even in June when the RBI met and the MPC deliberated over the conditions surrounding us, I think we knew very well that the tariff rate would be 26%. So I'm quite surprised that there's a lot of noise being made about the 25% which was announced, because 26 is almost the same as 25%. So I think we knew very well that the tariff would be at this particular range. And the RBI, when they penciled in their forecasts of GDP, had very much this particular thing in mind. And of course, if there are negotiations, there's a deal, things will become better. This other factor, which I think which created quite a bit of stir, was the inflation number. Now, if you actually look at the Q1 inflation number, it's turned out to be 2.7, RBI 2.9%, so not really very much different. Add to this the factor that the RBI mentioned in the policy very clearly that there are limits to which interest rates or the repo rate can be used to push forward growth. I think it falls in place that since the transmission process is going on, a large part of that has already been done. The RBI would, of course, take a pause, see how things work out, because we should keep in mind the fact that core inflation is still high at around 4.4%, and it's going to be fairly rigid in the coming months too. So therefore, pause, no change in stance, maybe some change in inflation forecast, 0.1, 0.2%, probably no change in GDP forecast too.
Right, point taken, Madan. But let me go to the other side of the camp. Sameer Narang, perhaps, who's a part of the other camp that says that there might be perhaps a surprise 25 bips rate cut. Sameer, tell us what's your thesis behind this rate cut. Now, while Madan has his own viewpoint, inflation has been well within the tolerance band for the RBI. Growth has been a point of concern, and now with the 25% tariff uncertainty that's come in on India, that could perhaps slow down growth further and put pressure on the exports. Are these the reasons for you to believe that there might be a cut?
I agree. I think growth has been a concern, as you're rightly pointing out. And growth currently is supported by front-loaded government spending. As you can see, both revenue as well as capex by the center is running far above what you typically see in Q1. It's also on a low base. Last year, because of elections, government spending was very slow to pick up. And you are seeing the reverse of that, which is driving growth higher for the economy. And apart from rural demand and government capex, the other segments of the economy are fairly slow. The second part, which I think which has changed since the June meeting, is the incoming HFIs have been fairly weak. If you see manufacturing activity or industrial activity in general, it's running at a much slower pace than last year. Credit growth has also moderated. And at the same time, we should not forget that the US exports, which India has done in Q1, were running at around about 22%. So there was a lot of front loading that has happened in exports as well, which was likely to moderate, but is going to moderate much more as the US economy is also slowing down after the payroll data that came out on Friday, which was far weaker than anybody had imagined. So overall put together, our view is that given that growth is likely to slow down in H2, when government spending may not be adding the kicker that it is adding right now, it's best time for giving private consumption and private investment a chance by lowering rates by 25 basis points when inflation is not a concern.
Right, Sameer, echoing your views, I guess Aditi also believes that there is going to be a rate cut. But one question to you, Aditi. In the last policy meeting, governor sounded that I have done 50 basis point cut. Now over to other factors for taking over GDP. And also just that inflation is under control. Do you think it is enough reason to cut now?
Put forward a few points. I don't want to repeat what Madan and Sameer have already said, but let me add to that. When the MPC last met, their forecast for CPI inflation for FY26 was 3.7%. We were at 3.5% then, and we're at 3.2% with a downward bias now. Yes, Q1 outcomes are not that different from the MPC's forecast, but Q2 and Q3, the trajectory is likely to be significantly lower. We are forecasting July CPI at around 1.4%, which will be the bottom, and thereafter there will be a normalizing as the base effect goes away, and inflation will kind of slope back upwards and cross 4% by Q4 of this year. So firstly, we are looking at CPI inflation being 50 basis points below the MPC's last annual average for FY26. Secondly, if we look at taking a pause now and waiting till October, the trajectory that we are going to look at after October is going to look far worse than what it is looking right now. So from an optics point of view, I would say either cut now or start the extended pause. I don't see any point of waiting till October to cut. The festive season is ahead of us. Better to let transmission happen if indeed we want to take a cut. So both from the optics point of view and the transmission point of view, I think this policy August scores over October. On the growth side, yes, while the rate is not significantly higher than what we earlier thought in terms of the tariff, the penalty also might be there. And also the relative position for India now seems weaker than what we had hoped it would be. We've actually reduced our GDP growth forecast for this year to 6%. And I agree with Sameer, there is some amount of front loading which has happened both in exports and in government capex. So on a low base, you've had a very high growth in capex. Second half of the year, the situation will be reversed. There'll be less headroom to incur capex, and the base will be much higher. So again, the GDP optics will probably look worse as we go into the second half of the year. That also would support a case for a rate cut now instead of waiting. So that's our call. While the probability of a rate cut is looking less than what we would have thought simply based on the CPI data alone, which is under flexible inflation targeting, something that the MPC does have to keep in mind, I would say the call is between a cut now or just starting the extended pause. I don't think October makes sense.
Aditi, that October doesn't make sense, and now is the time if the rate cut has to come through. But Kanika, let me come to you. You're from the other school of thought. So let me ask you one thing. I'll take a leaf from what Aditi just said. We are going to enter the festive season, and historically we have seen that rate cuts before the festive period augurs very well for a strong credit growth uptick. So now, a front-loaded cut could now perhaps boost the credit demand. Do you not think that this would be the right time to get a rate cut than October?
2 to 3 points. First of all, thanks for having me here. See, first and foremost, if you see the cycle we are in currently, 6 months back, we were in a cycle when inflation was falling and the trajectory was on consistent decline. Of course, July is when we see it bottoming out at below 1.5%. But today, the juncture we are in, when the RBI or MPC will assess it, we are actually likely to see an upward trajectory in terms of inflation. And the governor himself talked about in his recent interview that for him, what matters is forward inflation, maybe 6 month, 12-month forward, where numbers are likely to stack up closer to 4.5% if we go all the way up to April to June 2026, the first quarter of next year, for which the RBI will, for the first time, give forecasts in this MPC. So in this kind of a phase, when you've already front-loaded easing, and there's also impending easing in terms of CRR cuts, likely to start starting from September, we think there's a case for preserving ammunition after doing so much of front-loading in the kind of uncertain world we are living in. In fact, this just coming back to the point you made, see, today the issue is demand. And the supply side measures in terms of liquidity and rate cuts may not be sufficient enough to boost credit demand just because of one more additional rate cut ahead of the festive season. They've already done a little too much, which is 100 basis points rate cut, given 11 lakh crores of liquidity, another 2.5 lakh crores impending. Transmission of the same is already underway in the system, not yet complete. So they can wait for that to go through, which will also augur well for the festive season and the coming quarters. Thanks.
All right, Kanika, point taken. I want to come to you, Sameer. You are holding a view that there is going to be a rate cut this time, but could cutting now backfire actually, especially if food prices or global commodity prices flare up later this year? The environment we are living in, there are threat of tariffs, which is uncertainty still remaining as far as India is concerned.
No, it's a very good point. But I would be worried about commodity prices if you're optimistic on global growth. When you see the recent incoming information, particularly from the US economy, the payrolls which have got revised, particularly for the month of May and June, along with the subpar payroll number for July, it's very clear that world economy led by the US is slowing down. And that is ideally going to lead to lower commodity prices and not higher. Commodity prices this year have been higher also because of higher tariffs on a few commodities. And once you saw a tariff withdrawal on refined copper, prices went down. So ideally, I would see, or I would have a bias for lower commodity prices than higher when the world economy is slowing down. The second thing is that when you see the producer price inflation or WPI index in India, that is also fairly muted. When you see corporate results which are coming out, that also tells you that demand is fairly weak. Financial stress is building up as we see numbers coming out for a number of small finance banks or for NBFCs put together. That gives you a picture of weak urban demand when rural demand is holding up, and that implies limited pricing power for the corporates in India. So I would reckon that the headwind that we have in terms of lower global demand led by the US, as well as weak urban demand, should ensure that inflation in India is also fairly well behaved. The sequential momentum that we see next year is also telling us that inflation on a sequential basis is likely to trend closer to 3.5 to 4%, though the headline number will be much higher on a low base. So in our opinion, we actually expect commodity prices to be on the lower side than on the higher side, given the backdrop of weak global growth.
In that case, Samir, I'll take a leaf from what you said. Coming to you, Aditi, since you are also in the favor of a rate cut, if the commodity prices are likely to remain, are likely to be within the tolerance band or remain benign because of the global growth slowdown, and then in your opinion, can this be deferred as well, like October to December rate cuts, can that be on the cards if that be the case?
I think carrying forward the front loading might be a better option. So again, as I was saying earlier, firstly, the trajectory for inflation when we're sitting in October will look a lot less than what it is looking today. We'll be looking at a second half inflation which will be much higher than the first half inflation. And going into FY27, where because of the base effect, most certainly inflation will look higher than the 3.2% average that we're talking about, at least in terms of our forecast for FY26. So it'll be harder to cut than it will be to cut now in terms of the inflation outlook point of view. And, transmission both to the lending rates and the deposit rates, that's something. But I think also we need to think about transmission to another important factor, which is the small savings rates. And if we have a cut now, then there is some hope that there may be a modification in the small saving rates when they're next up for revision in September. If the next cut is only in October, then I would imagine that we're probably not looking at a revision in the small savings rates till December.
All right, point taken. Although we have a divided house, but one consensus which I can take safely is on inflation, and that outlook might be revised. I want to come to you, Kanika, for that. How much expectation you have?
So we are at 3% for this year. From 3.7% last time, we think the MPC may move closer to 3. But for next year, for Q1 FY27, for which they'll give the forecast for the first time, the number is likely to be, for us, it's tracking around 4.3, 4.5. So maybe a higher number, that's it.
Right. Also, I want to ask you, Madan, regarding the growth forecast. Do you think there is a scope of revision or the status quo will remain?
The number will remain where it is because, right now it's just a matter of conjecture. We are all saying that in case the tariff is 25%, which it is, of course, that our exports are going to get battered, and that's why GDP growth will come down. Now, our estimates here in Bank of Baroda that the hit could be not more than 0.2%. So that's why we have a GDP forecast of 6.4 to 6.6. 6.4 is the worst case scenario. So the RBI could also probably take a view on how growth could be impacted and accordingly revise it maybe marginally downwards. Or it may just probably prefer to wait and see how things happen because one is not quite sure about what could be the penalty, whether there is a deal which is being struck. Because we should just remember that the government is working hard to strike a deal with US. In case that happens, there's definitely a case for saying that we may not be living at 25%, and the overall impact on growth will be less serious than what we are anticipating right now.
Right. Madan, I'll stick to you because, Aditi had mentioned that if not now, the rate cuts don't come through, then it's going to be slightly difficult for that to happen in the month of October or December. But right now, growth is a concern. Growth has slowed down, and like you mentioned, the impact of tariff is yet to be seen. A 25% tariff will mean that the exports will take a beating, and so will the growth. So keeping that in mind, what is your opinion on, you just spoke about the growth forecast, but talk to us about what would be your opinion on the fact that, despite, I mean, because of the tariffs coming in, we don't know how it's going to play out, but that will impact the growth. What are going to be the triggers for growth going ahead in that case?
See, I think there is a bit of confusion here when we talk about India's growth. See, last year, we all began the year by saying we're growing at 6.5%, and I don't think anybody had a problem out there. Now, once a tariff issue comes, maybe there's a downward revision by some of the economists. We're talking of 0.1, 0.2, 0.3, whichever way it is. And I think it's universally accepted that India is the fastest growing large economy, which means that India is actually doing well relative to all other countries. So to my mind, we should not be blowing this out of proportion and reducing the interest rates in a hurry to say that we're able to do it. Because as Kanika said, and which I subscribe to, people don't just borrow money because interest rate is cheap. How many of us on this particular panel are going to buy a house merely because the rates have come down by 100 basis points? The answer is probably none of us are going to do it. The same thing holds for industry. You have surplus capacity. There's no reason why you should be investing. Even today, if you watch on your channel, you have all the FMCG companies coming and saying that we are not having enough demand. That's why the Q1 results have been affected. In this kind of a situation, saying that I've lowered the rates, MCLRs have come down, your EBLRs have come down, therefore you start investing more, it's not going to happen that way. And I think if we believe in this particular theory that inflation will be crossing 4% in Q4, let's look at this kind of a situation. We lowered the repo rate to 5.25, and maybe after 2 months when you call us on this panel, we'll again say there will be a divided view. Again, we'll say lower it to 5%. We'll actually be talking of a real rate of around 1% or 1.25%. And today, of course, it looks 3%, now go down to 1.25%. So I think I'll go with what the governor said. We need to be forward-looking. And we need to look at inflation, how it pans out in future, because it can't be a situation that my real interest rate actually turns lower. You will actually have to start increasing rates to justify what we have done today.
Right, point taken, Madan. But quickly, I want to do a small poll with all four of you, and this is regarding the terminal rate. Where do you see this cycle? Starting with you, Samir.
So our opinion, if the rate cut happens in August, 5 quarters is where the terminal rate settles ideally.
Right. Aditi, what is your view? Terminal rate?
Same. If we get a rate cut in August, then 525. If we don't get a cut in a couple of days, then 550. I don't see any point of cutting in October.
Right. Kanika?
So I'm at 5 quarter. The only reason I want to keep that 25 basis points alive is if growth falters. That's on close watch.
That is also a valid point. And last one, but not the least, Mr. Madan.
I would say 50% chance that we go to 5.25, but that would be more likely in December after we have seen the full transmission of this 100 basis points.
Thank you so much. Here's hoping that a Fed doesn't pull out of RBI. Hopefully that won't happen, and there'll be a common consensus as to whether they will maintain status quo or there will be a rate cut. But we'll watch out for that. But thank you so much, Samir, Kanika, Aditi, and Madan. Thank you so much for taking the time and joining out for this show.